There's a lot of debate over individual stocks versus ETFs. And I'm here to say that the individual stock pickers are garbage. They can be great. You can get all the upside. But at the same time, you get all the downside. And it all comes down to luck. No amount of analysis from a team of overpaid math nerd Ivy League quants could anticipate Tesla dropping 50% because Elon tweeted the N-word with a hard R at Neil deGrasse Tyson or Barack Obama, and then tried to backtrack and say that he could because he owned Twitter and he's technically African. We're going to take a look at the absolute chads investing in index funds. They don't worry about anything. They're out there maxing their accounts, maxing their retirement accounts, pouring all their money into VOO or SPLG or FXAIX. And they don't lose a wink of sleep because they know they're going to get that average 10% a year. So while you're sitting there pouring Wendy's paychecks into Bed Bath & Beyond and Peloton, thinking that there's going to be a big breakout or the price is going to explode because there's going to be some other reason why people are getting back into the stock. The index fund Chad doesn't even check the price tag of what he's putting money into. He doesn't check the Heiken Ashi charts. He doesn't check retracement patterns. And he has all 5 free articles per month on Seeking Alpha. And once he's got enough shares, and maybe if he decides at any point to be a little bit interested in investing, he can start sitting there selling covered calls to the idiots that'll buy 1% out of the money, 30-day to expiration calls on SPY or VOO or whatever. And he'll have enough money to be able to buy a Camaro to drop his kid off to school in, revving the engine in the parking lot, being the coolest dad, calling people Haas and brother. And he doesn't care if the market's up, down, or sideways. He's making money while you are wasting your money on meme stocks and penny stocks and all of the hyped big things that happen to make up a majority of the indexes anyway. So if you're investing in the index, you're already investing in all of these companies. The only advantage that you get from investing in the Magnificent Seven is that I guess you get a little bit more exposure to the price action of all of them, while also being exposed to the 50 to 70% drops and everything else like that. So while you're wasting your money on meme stocks, penny stocks, and whatever else, with those Lambo dreams and that Arby's shift lead paycheck, the index Chad could legitimately abandon everything and go live in a cabin in the woods like Uncle Ted and have invested $100,000 into indexes. And he could come back 20 years later to over $500,000 while doing nothing. It was just working its magic. So what were you doing in the meantime? Like, you invested in some companies that went bankrupt. You tried dividend stocks, options, derivatives. You were looking up kidney prices on the dark web because you only need one. And you were massively up on Amazon right before the news came out about Amazon's corporate child trafficking system. Between the indexes and individual stocks, you should always pick the index. I don't care if it's the S&P 500. I don't even care if it's the NASDAQ or some other index that tracks like a sector or something. The indexes will always outperform compared to the amount of work that you have to put in to be on top of investing and trading in individual stocks. So be like the Chads, invest in the index.